Hey guys, what's up? Hope you are enjoying our sessions. If you like for us to address any specific topic of finance, please leave the topic in comments below. Today we will have an overview of futures and options. Let's get started. What is derivative? The area of the market for derivatives is regarded as very lucrative since it gives investors the ability to earn profits, or incur losses, by paying a minimal margin. Futures and options are the two main categories of derivatives. In addition to providing a hedge against price volatility, they may be traded on commodity, stock, and currency markets. Those who are indifferent in the underlying asset might benefit from price changes via futures and options trading. For instance, you are interested in F&O wheat trading. You are not interested in stockpiling tons of grains, but you are interested in profiting from price swings. Then, you may purchase wheat futures and options without actually receiving the product. The majority of F&O market participants are speculators who are not really interested in the product. This is positive since it helps to the liquidity of the market. What are futures? A buyer, or seller, agrees to purchase, or sell, a predetermined amount of an item at a specified price at a future date. Let's demonstrate this with an illustration. Suppose you purchased a futures contract to purchase 100 shares of company ABC at 50 rupees per share on a certain date. At the conclusion of the transaction, you will get 50 rupees per share regardless of the current market price. Even if the price increases to 60 rupees, you will purchase the shares for 50 rupees apiece, resulting in a profit of 1000 rupees. Even if the share price falls to 40 rupees, you will still need to purchase them for 50 rupees apiece. Consequently, you will incur a loss of 1000 rupees. Futures contracts are not just available for stocks. You may acquire futures contracts for agricultural commodities, petroleum, gold, money, etc. Futures are crucial for avoiding the danger of price changes. Let's look at different types of futures. Stock futures. In India, stock futures index futures debuted in the year 2000. A few years later, individual stock futures were introduced. There are several benefits to trading stock futures. The most significant is leverage. Prior to investing in stock futures, you must place an initial margin deposit with your broker. If the first margin is 10%, for example, you may trade 50 lakh rupees worth of futures by paying the broker just 5 lakh rupees. The greater the transaction volume, the greater your profit. But the significant hazards are also greater. Stock futures may be traded on stock exchanges such as the BSE and NSE. However, they are restricted to a certain selection of equities. Index futures. Index futures may be used to bet on the future fluctuations of indexes such as the Sensex and Nifty. Suppose you purchase BSE Sensex futures at 40,000 rupees with a month-end expiration date. If the Sensex increases to 45,000, you stand to gain 5,000 rupees. In the event that it falls to 30,000 rupees, your losses would be 5,000 rupees. Portfolio managers utilize index futures to hedge their equity investments should share prices decline. Index futures in India include Sensex, Nifty 50, Nifty Bank, and Nifty IT, among others. Currency futures. Currency futures are one of the numerous forms of financial futures. This futures contract enables you to purchase or sell a currency at a fixed rate relative to another currency, Euro versus USD, etc., at a future date. These are used by risk-averse individuals and speculators. For instance, an Indian importer may acquire USD futures to hedge against any strengthening of the dollar relative to the rupee. Commodity futures. Futures contracts on commodities provide hedging against future price fluctuations of agricultural items, gold, silver, gasoline, etc. In addition, speculators utilize them to wager on price changes. The currency markets are extremely volatile and dominated by huge institutional participants, such as corporations and governments. Since initial margins for commodities are minimal, participants in commodity futures may take significant bets. Obviously, the profit potential is immense, but the hazards are often significant. On commodity markets in India, such as the Multi-Commodity Exchange, MCX, and the National Commodity and Derivatives Exchange, these futures are traded. Interest rate futures. One of the many kinds of futures is an interest rate future. It's an agreement to purchase or sell a debt instrument at a set price and date. Government bonds or treasury bills serve as underlying assets. These may be traded on the NSE and BSE. What are options? This differs from a futures contract in that it offers the buyer, or seller, the right, but not the duty, to purchase, or sell, a certain asset at a predetermined price and date. Call options and put options are the two forms of options. A call option is a contract that gives the buyer the right, but not the duty, to purchase a certain asset at a given price and date. Suppose you acquired a call option to purchase 100 shares of company ABC at 50 rupees per share on a certain date. However, the share price falls to 40 rupees below the contract's expiration date, and you have no interest in carrying out the deal since you would incur losses. You then have the option to decline to purchase the shares for 50 rupees. Therefore, instead of losing 1,000 rupees on the transaction, you will just lose the premium paid to get into the contract, which is much less. The put option is another sort of option. In this sort of contract, assets may be sold at a predetermined price in the future, but the obligation cannot. For instance, if you have a put option to sell company ABC shares for 50 rupees at a future date and share prices climb to 60 rupees before the expiration date, you have the option not to sell the shares at 50 rupees. Thus, you would have avoided a 1,000 rupee loss. If you found this video useful, please like, share and comment. Don't miss our next video and subscribe to our channel.